As I mentioned at the top of the hour, when you understand the Wall Street fashion show, you can make sense of the perplexing action that haunts us every earnings season. For example, this morning, Eli Lilly and Boston Scientific both reported great quarters. But Eli Lilly's stock got hammered, down more than 2%, while Boston Scientific's rallied 5%. Why? Because this market's not willing to give drug companies the benefit of the doubt. No how, no way. Not in a moment when the Democratic presidential candidates are debating single payer. And even the ones who are against Medicare for all tend to favor cracking down on big pharma. But Boston Scientific, it's a medical device maker. And for whatever reason, the medical device industry is sainted. It's much less hated than the pharmaceutical industry. And that's why this group tends to roar whenever Washington focuses its ire on the drug companies. Sure enough, the earnings season we've gotten so far, it's revealed some terrific numbers from the medical device plays. Not only are these stocks in style on the Wall Street fashion show, their underlying fundamentals are in fabulous shape. Let me tick them down for you, starting with longtime Cramer fave, Intuitive Surgical, which reported a fabulous quarter last Thursday. You know Intuitive Surgical is the company behind the Da Vinci robotic-assisted surgery platforms that helps doctors perform all sorts of minimally invasive procedures. The idea here is that their machines get you in and out of the hospital faster, and shorter hospital stays translate into more savings for the healthcare system. Isn't it great to have an icon come back as a machine like the pictures that we have of Da Vinci? At this point, we've got to say, they've got so many robots now working in the hospitals that they're making a fortune, not just from the robots, but from selling the consumables that doctors use every time they perform surgery. It's the classic razor blade business model. Da Vinci meets Gillette. In March, we spoke to Gary Goodhart. He's the Intuitive Surgical CEO, and he laid it all out for us. Take a look.
The way we look at it, we're in the business of helping our customers, which are hospitals and surgeons, deliver for their customers, the patients, the quadruple aim. Better outcomes, better patient experience, better experience for the healthcare team, and lower total cost to treat.
Mr. Goodhart also pointed out that the growth remains very strong. Last year, the number of procedures using Intuitive Surgical systems increased by 18%, double digit, and he noted that the company is launching a whole new bunch of products. However, a little over a month later, the story developed this bit of a complication, new wrinkle. Intuitive Surgical reported a seemingly mixed quarter, earnings coming in weaker than expected. While management raised their full-year procedure growth forecast, they also boosted their operating expense forecast. So suddenly investors started worrying about costs. When you're dealing with momentum stocks, the last thing you want to see is an imperfect quarter. There was no margin for error here. In response, the stock got blasted. Intuitive had been in the 580s, then within a week it was at 500, and then by early June it had fallen to 455. Fast forward to July, and ISRG delivered a strong quarter, clean top and bottom line beat with slightly raised guidance. But every time the stock tried to rally, it quickly rolled over. Plus, it didn't help that the market turned against growth stocks in August. It's not until last month that this thing really started turning, thanks to a couple of positive analyst reports and some catalysts. First, Intuitive Surgical made a bunch of bullish presentations at industry conferences last month. Second, when Medtronic launched their own robot-assisted surgery system, big competitor, well, hold it. The consensus seemed to be that it was underwhelming, and that removed a major overhang for Da Vinci. Third, the whole medical device cohort had gotten its groove back, so buyers were finally willing to listen to good news from ISRG, which brings us to the quarter they reported last Thursday night. This time, Intuitive Surgical knocked it out of the park, a magnificent 44-cent earnings beat off a $2.99 basis and substantially higher than expected sales. The number of procedures conducted on the machines increased by 20%. Management raised their full-year procedure guidance to the 17 to 18% range. That's the third consecutive quarter where they boosted this number. At the beginning of the year, they were only talking about 13 to 17% of procedure growth. Cherry on top, ISRG actually cut their operating expense forecast. That's the thing that everybody freaked out about in April. This was a fabulous quarter across the board. That's why the stock surged 7% on Friday, rising to 566. So what do I talk about now? Why bother? Because it's come back down, sinking to 535, and even though it's now back to 540, you're still getting a big chunk of that latest quarter for free. I like this stock right here. Management's put most of the worries to bed, rising cost, newfound competition, and they're now showing us exactly why we've always loved ISRG on Mad Money. Now, the stock here, okay, it's not cheap. It sells for 38 times next year's earnings estimates. But when you consider that Intuitive Surgical has accelerating growth, rose from 15% in the first quarter to 21% in the second quarter to 22.5% in the most recent quarter, I think it is worth paying up for the best of the best. Sell-off, gift. How about the rest of the medical device cohort? Earlier, I mentioned Medtronic, huge medical technology conglomerate that's not getting much credit for its new robotic surgical system. But you know what? There's so much more to this company than that. Now, the company just rolled out some major new products for spinal surgery. They're part of Medtronic's recent acquisition of Mazor Robotics. Remember that Israeli company we like so much? That's like a much smaller Intuitive Surgical. But the launch was light on details. So investors ended up selling the news. I believe in the Mazor deal. So I view the pullback as a buying opportunity. Medtronic trades at less than 18 times earnings. It's a steal. And if you remember, back in January, we seemed to talk the CEO into recommending a stock. We were more bullish than he was, and the stock was in the 80s. Hey, sometimes you get a little constructive. Then there's Cramer fave Abbott Labs. Now, last Wednesday, Abbott reported solid quarter, less than stellar guidance. But there's something you may have missed. The day before that, they announced a partnership with Tandem Diabetes, the maker of high-tech insulin pumps for people with diabetes. Tandem caught fire in the news. It's up 11% since. I feel Abbott should have been up much more. There's yet another reason we own it for the charitable trust, which you can follow along, by the way, by joining the club, the ActionAlertsPlus.com club. More importantly, the company's got some promising stuff in the pipeline for heart disease and diabetes. This stock is mispriced. It sells at 22.6 times earnings. Miles White runs this company, for heaven's sake. He's got one of the best total shareholder returns of any CEO in existence. Abbott, terrific buy, right here, right now. Speaking of diabetes, don't forget about Dexcom, maker of continuous glucose monitors. Basically, they make a sensor that tracks your blood sugar so you don't have to draw blood multiple times a day. Hey, they got some good stuff working with Apple. Dexcom's been a huge, long-time winner. I mean, it's one of our absolute favorites. Now, the stock's been hit hard over the last couple of months. I don't like that Tandem's teaming up with their competitor, but I think there's enough room for multiple players in the space. Dexcom, we believed in it for 100 points. We're not giving up. Now, this morning, Boston Scientific shot the lights out. The medical device maker delivered a nice top and bottom line beat, surged 5%. More upside coming. Finally, there's another one that we've loved for so long, getting the love that it deserves. Edwards Life Sciences, which revolutionized the development of heart valve replacements that can be installed without cracking the chest cavity. Saves lives, saves the system money. Edwards just reported a fabulous quarter after the close today, and the stock is surging. I've liked it for a long time. I still like it. Bottom line, whenever Wall Street's skeptical of big pharma, you tend to get some nice outperformance in the medical device stocks. That's still one more reason to buy the med tech names that have already reported strong numbers, like Intuitive, Abbott Labs, Medtronic, Boston Scientific, and Edwards Life Sciences. I think this market's eager to embrace the medical device cohort. Why fight the tape when you can fight right alongside it? Much more Mad Money ahead. John Donahoe is leaving big shoes to fill when he heads to Nike. I'm talking to the outgoing and incoming CEOs of ServiceNow. See what's ahead. And does the sell-off in Texas Instruments foreshadow a drop in the entire chip stock group? Don't make a move before hearing my take. And all your calls rapid fire in tonight's edition of The Lightning Round. Stay with Cramer. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.